Welcome back. We're going to get started now with my pleasure to introduce Lars Powell.
Well, hello, and thank you for having me. I'm Lars Powell. I'm at the University of Alabama, where I direct our Center for Risk and Insurance Research. Our center identifies and solves risk and insurance problems with research, education, and outreach. And it's probably my favorite job I've ever had because I like to talk about insurance. I like to read about insurance. I like to do research on insurance markets, as I've done for about the last 27 years. And so today I want to share a few things with you about insurance in California. A few years ago, we were approached by some folks who wanted us to write a critique of Prop 103 that uses like data and math and sound reasoning to, so it's not something you could usually do for an academic audience because we already know that this stuff is obvious. But we were able to get this paper published in the University of Connecticut Insurance Law Review, which is a high-quality publication, because it was a highly salient issue. So everything I'm going to share with you, all of the evidence, is in those peer-reviewed and published papers. And I think we've got some copies here. You can go to a website that Alan will tell you about at some point and download them if you'd like to see them. But today, oops, wrong button, okay. I want to talk about Prop 103, and I call this presentation a case study in regulatory failure. I'm not meaning that any of these individuals are failures in and of themselves, just that this is very poorly conceived and poorly executed regulation. Today, the insurance industry is beset with all kinds of actual problems. We have wildfires, hail, hurricanes. We've had reinsurance prices that until this year have gone up a lot with inflation. Now, important, none of these are insurance problems per se. Insurance is where you feel the pain. All of a sudden, and this happened after Hurricanes Ivan and Katrina in Alabama, Mississippi, Louisiana, along the Gulf Coast, the Gulf of America coast, as we call it now. And people said, wait a minute, for the last 20 years, I've been paying $800 or $900 a year for my homeowner's insurance, and now it's $2,500 a year. First of all, have you ever heard of inflation? How'd you pay the same thing for homeowner's insurance for 20 years in a row? That's got to be false. Number two, most of these companies didn't realize what exposure they even had in these areas. This was before a lot of the large carriers even had geolocated all of their houses. They just knew how much premium they were getting, how many losses they were paying out. And then all of a sudden you have 7 of the 10 most expensive hurricanes in the history of insurance since we've been recording it happen in a 14-month period. Say, hey, wait a minute, we better find a way to price this. So you feel the pain in your insurance premium, but this isn't a insurance problem. It's really a how you build your house problem, a where you put your house problem. California's problems are insurance problems. But it's not that the insurance mechanism doesn't work here, it's that insurance regulation doesn't let the insurance mechanism work here. So I took this out of one of the trade press magazines. It shows premiums and losses, or I think profits and losses for California homeowners insurance from 1991 through 2018. You can see that through 2016, it had accumulated about $10 billion in profit over about 25 years, which is probably about right. Risk reward, you would think, oh, okay, $10 billion, it's not a very large percentage of the total given how much exposure there is here. But then you had 2 years, 17 and 18, it lost on average $10 billion each year. So after just those 2 years, you've got a 27-year total profit of negative $10 billion. Well, they say, oh, that's just, that'll all average out. We'll never have big fires like that again. Why are we here? Palisades Fire was made those look tiny. So there's a bit of cognitive dissonance in the idea that we can just let it be. Don't do anything because it'll upset people, it'll upset the market. And so that's the first approach that we see from some state regulators. And these are tables from our paper, so the data end in 2022. I'll tell you that they would not have improved if we brought the data through. I think 2024 is now available. These are from rate filings. And this is the average days to resolution from 2018 to 2022, and California is in red. You can see Colorado took this to the extreme, an average of 420 days. This is auto insurance, this is homeowners insurance. The idea is, hey, let's just ignore it and hope it goes away. Delay, deny, stretch it out, and maybe the market will fix itself. I call this the ostrich plan. It's never worked very well for the bird. That's not a good defense right there, to stick your head in the sand. But it's what, hey, well, let's, there's this deemer provision that Christian told you about, supposed to approve, if they don't respond to a rate filing within, was it 30 or 60 days, it's automatically approved. But you have, as an insurance company, you have to waive that when you submit your filing. So it's a false law. The next thing is the regulatory rate suppression, which Christian also told us about. I'm giving you some context compared to other states. This one, so California is to rate suppression what Alabama is to college football. I say that as a South Carolina Gamecock fan, so I don't really brag about football a lot. But you've got average rate suppression. This is an average over 5 years. Average rate suppression in homeowners insurance, 28%. That's the difference between what's applied for and what's approved. And for auto insurance, it's like 16%. Applied for, indicated versus approved. So what the actuary says you need versus what the regulator says you can have. I call this one the King Canute. Is anyone familiar with King Canute? He was said to be the best political leader and king of all times. I think he was like a Viking that was over the United Kingdom for some period of time. And his followers, his subjects said, "You're so powerful, I'll bet that you could command the tide not to come in, and it would stay." So they carried his throne down to the beach, and he said, "You shall not rise." The king got wet that day. And it's very similar to what happens when an executive in charge of insurance regulation says you may not let your insurance premiums go where they need to be. We insist that you lose money. There's the old joke about that between actuaries and insurance agents that they're like, hey, you lose a little bit on each transaction, but you make it up on volume. You know, that doesn't really work, right? You just lose an awful lot. But so the King Canute was, you know, like I said, the king got wet, and so does every regulator who tries to, by fiat, demand that insurance rates stay below where they should be. Now, how do they do that in California? I'm not going to go back through all the details. I probably haven't memorized them as well as Christian has. But Prop 103 passed in what, 1988, and I've got you a picture of a Ford F-150 from 1988. That one was for sale on Facebook Marketplace. That is the sort of stuff that comes up in my feed because I live in Alabama and I like to fix old junk. My wife says I have a tractor problem or a tractor habit. I say it's a hobby. But, and this is a 2025 Ford F-150. One of them gets you where you want to go a lot better and a lot more comfortably than the other because it's got all the modern bells and whistles. The homeowners rates, not being able to use catastrophe models, except for the FAIR plan. Seems, you know, good enough for thee, but not for me, or vice versa, however that works. or reinsurance costs. For auto, you can't consider the two most accurate things in setting automobile insurance prices. The intervener process, which we've talked about, and I think we're just going to keep talking about that one because it's so good. Let's pay somebody to gum up the system and slow it down and make it so that you can't charge the prices that you need. And then we already mentioned the false steamer provision. So all of this would not be so bad, right? It could make premiums not enough in some instances, but the other thing it does is it keeps insurers from operating and doing what they do. So segmentation. I won't keep you in actuarial science class for too long. I am a recovering professor, and sometimes I do this by accident, but the way that insurance companies compete with each other is they try to segment people into large groups, but specific groups where they can charge less money for that group than the other company is charging and still make a profit. And by following that strategy, the consumer who shops for their insurance winds up with the very best price they can possibly get. It's very efficient. If you're not allowed to use all of these accurate predictors for setting prices, then you never get that efficiency in your market. And I'm going to show you what happens when your market lacks that efficiency. So this all seems obvious that Prop 103 is a bad insurance system, but there are people who will tell you that Prop 103 is the very best insurance regulation system you could possibly have. This is a paper by my old buddy J. Bob Hunter and Douglas Heller, insurance expert. I don't see Bob that often anymore. I think he's retired. So they put out this paper and they show that other states would save $60 billion a year if they just had Prop 103. And what I'm going to show you is that if you dig into the details, you realize that either they're very bad at math or they're not very honest. I'll let you be the judge because I really couldn't tell you which one it is. Having spoken at length with some of these folks, I know that numbers are not their strength. But Bob Hunter's a fellow of the Casualty Actuarial Society, so he should at least be able to do the simple addition, subtraction, multiplication, division. They tell you that because California's insurance premiums only increased from 1989 to 2015 by 12.5%, and everybody else's all the other states increased by 61%, and the comparison in just the liability premium is even more desperate, even more different, that this pattern of premiums shows that everyone else would save money if they just had Prop 103. Well, and by doing this, all of these states, if you just impose those premium patterns, would save this much money, and it turns out to be about $60 billion total that they would save. So if you're intellectually squeamish, you may want to cover your eyes now, because this is kind of like throwing dodgeball at the sumo wrestler, but I'm going to take you through the process of explaining why they are incorrect. Nothing? Dodgeball at the sumo, and that's all? Okay. I came all the way here from Alabama, y'all. That's a 5-hour flight. So, pop quiz. What determines insurance premiums? Is it the premiums themselves determine the premiums, or do insurance losses determine the premiums? I'm going to suggest that it's the losses that determine what the premiums have to be, at least if you want your insurance company to survive. You can't just say, well, we charged this last year, so let's charge this next year and not think about how much you paid out in losses. Your premiums are all about what your losses are. Every empirical model shows that. So this is the losses per car in California from 1987 through 2006, just showing some of the big changes. So what happened in 1991? Royal Globe took away the first party, the Royal Globe case took away the first party direct action to be able to sue your own insurance company for losses or something like that. And so it changed the loss trajectory. The losses per car, and this isn't like real losses, this isn't adjusted for inflation, this is just how much it was. So it was going up, and then the losses came down. Now what part of Prop 103 would make losses change? Prop 103 talks about the premiums and how you calculate premiums. It says absolutely nothing about losses. But what they're taking credit for in their analysis is that the losses went down. This is the ratio of bodily injury to property damage losses in California versus the rest of the country. So think about it. For every property damage loss, that's a chance to have a bodily injury loss. And across the states, what would make it different? You know, we're averaging out across all the people that crash in a state. Why would, if you've got 20 BI claims, bodily injury claims per 100 property damage claims in the rest of the country, say if you're in Nevada, but in California you've got 65. Are the crashes that much worse in California? No, it's that you get that much more when you sue, at least you did before the Globe decision. And so that Globe decision put this trend in place, and since then, the losses in California have really improved. I was struck with how good it seems drivers are. Maybe you're just stuck in such gridlock traffic that you can't get going fast enough to cause a really good crash. You know, in Alabama, we can really crash. A lot of times we don't have to have anybody to run into, just a telephone pole on the side of a 2-lane road at night, maybe with flashlights and guns, probably a couple beers, but we'll crash those cars for you. Here is California's losses, like I just showed you, and here's the premiums that were charged. So when the losses start going down, and you've got Prop 103, you don't want to reduce your premiums because you know you can't raise them back up when you have to. Why would you ever take a premium reduction if there's no way to compete for business because you can't price people accurately and you know that you can't